Hi, I'm Joanna Tano, Head of Research at Columbia Threadneedle Real Estate Partners based in London. And I'm here with my colleague, Hans Nordby, Head of Research and Analytics at Lionstone Investment, who's based in Boston.
Hello.
Today, we're going to discuss residential rent and global cities. Hans, over to you to begin.
Some things in life are simple. The level and trajectory of a property's rental profile appears highly correlated to the amount of money that flows through that building. Office rents in London's Mayfair or in Palo Alto, California are high not so much because the sticks and bricks are so remarkable, they can be, but oftentimes these are dated structures. Rather, because the venture capital funds, tech firms, and family offices in the properties are awash in capital themselves. Correspondingly, if residents of a city or neighborhood have relatively rising incomes, one would expect housing rents in that geography to increase faster on a relative basis. At the metropolitan area or city level, this might be described as widespread economic success, and at the neighborhood level, gentrification. Our research indicates this common sense applies to most real estate product types and presents a simple framework for investors to identify markets that will have outsized rent potential. In the States, for the decade ending in 2022, multifamily rents in the U.S. grew slightly faster than incomes, averaging about 3.7% growth annually versus household income growth at about 3.2%. There was, however, significant variation around that average at the metropolitan area level, that we can see on the chart on screen. Metropolitan areas with above-average population growth, such as Raleigh, North Carolina, and Dallas, Texas, often posted rent growth more than their already strong income growth would indicate. We believe this makes sense, as markets with growth in the number of households put upward pressure on occupancy rates, another lever for rent growth. Indeed, all of the markets on the graph where rent growth was above trend also had above-average population growth. New York, LA, and Boston are often characterized as attractive investment markets because they have high barriers to supply, commonly believed to support higher occupancies and, as a result, stronger rent growth. Each of these markets posted lower rent growth than the U.S. average during this long period, potentially due to below-average population growth. In addition, the pandemic allowed more people to work remotely and accelerated migration out of the more expensive coastal market, adversely impacting rent in the last 3 years of the period shown. Joanna, how does this work in Europe?
Thanks, Hans. Well, across the European Union, average disposable income growth per household rose by 2.3% over the same decade, so the 10 years up to 2022, outpacing residential rent, which grew by 1.4% per year over the same timeframe. A similar trend is observed in the UK, whereby incomes rose by 2.4% per year over that decade, with the average rent across the country rising by 1.9%. But as always, the devil is in the detail, and country-level information can often does distort and mask what is happening at a city level. The rationale for the rental growth story is pretty straightforward. The much headlined COVID exodus from Europe city centres was the story that never really happened. Yes, some moved out of city centres to more leafy suburban areas and idyllic rural villages due to the pull of more space and a healthier way of life. But the reality is that capital and strong Tier 2 cities have seen populations grow recently, as a combination of immigration and younger people actively desiring more central locations that are the bastions of economic growth and employment. Limited supply is also a contributing factor to the positive rental growth that we're seeing in the residential market, as is affordability due to the recent mortgage rate hike and that incomes have grown by less than house prices, pushing more people towards that rental market. At a Eurozone level, house prices have increased by 3.1% per year between 2000 and 2020, while real earnings have only grown by 0.3% over the same timeframe. Some cities are doing better than others, but perhaps for differing reasons. But the underlying common thread is economic strength. This reinforces the relationship between household income growth and residential rental growth. To pick a few examples in Europe, Dublin in Ireland is an important European tech leader and is drawing in new talent as the sector grows and evolves, and now sits alongside the likes of London, Berlin, and Paris, the latter perhaps dragged down by some regional cities that are contributing to the overall country figure. And for example, in the Netherlands, in Amsterdam, and nearby Eindhoven are agricultural technology-rich locations, attracting a highly skilled talent pool. And other cities such as Lisbon and Barcelona are boosted when measured on appeal to remote digital workers alone, thanks to the lifestyle that they offer. Plus, these cities have a relatively low cost of living compared to other Western European capitals, which makes them attractive to young professionals and digital nomads. So after that quick overview of what we see happening in Europe, I'll hand back to Hans for some closing comments.
And so in summary, we believe the data tells us residential rents are better supported in metropolitan areas where incomes are rising at an above average pace, and therefore think investors are well served to seek those geographies. Government controls such as rent regulation or supply constraints will of course play a role in actual rent growth, especially in Europe, just as housing supply may temper rent growth, especially in the US. But we believe the combination of factors will drive investor outcomes in housing. Thanks for tuning in.